On the first paycheck of 2026, a quiet change buried in a law most people never finished reading reached into the retirement accounts of millions of older workers and took away a tax break they had leaned on for years without ever thinking about it. No headline announced it on the day it landed. No letter arrived in the mail. If you are 50 or older and you earn a solid income, the rules for how you are allowed to boost your retirement savings changed on January the 1st, and the change costs money, real money, right now, in the year you can least afford a surprise on your tax bill. Here is what I promise you. By the end of this, you will know exactly whether this rule touches your money, the single dollar figure that decides who is caught and who walks free, and the two things you can check this week to find out precisely where you stand. You will not need an accountant to follow it. You will not need to understand a word of tax law. You will just need to stay with me because the details are where the money is, and Washington is counting on you not reading them. The change comes from a law called the Secure 2 Act, which Congress passed at the very end of 2022. According to the IRS, one provision inside it, known as Section 603, rewrote the rules for something called catch-up contributions. And in September of 2025, the Treasury Department and the IRS released the final regulations that lock it in, which means that as of the first day of 2026, this is no longer a proposal or a plan. It is the law you are living under right now. Let me tell you why this matters even if you have never once looked at your retirement statement. A catch-up contribution is the extra money the government lets you put into a 401k after you turn 50, on top of the normal limit, because you are closer to retirement and need to save faster. For years, higher earners could put that extra money in the traditional way, meaning they got a tax deduction for it today and paid the tax later in retirement when many people are in a lower bracket. That deduction was worth thousands of dollars a year to the people who used it. And starting in 2026, for a large group of those people, it is gone. Not the catch-up itself. You can still make it. What changed is when you pay the tax on it. And that single shift from paying later to paying now is the whole story, because for someone in a high-tax bracket in their peak earning years, paying the tax now instead of in retirement can be one of the worst possible times to hand the money to the government. I want you to notice something about how this arrived. It did not come as a new tax with a big announcement. It came as a technical change to a retirement rule, written in language designed to make your eyes slide right off it. That is not an accident. When Washington wants to raise revenue without the political cost of a visible tax increase, this is exactly how it looks. A quiet provision, a delayed start date, a final regulation dropped on an ordinary day in September. And by the time it reaches your paycheck, it feels less like a decision someone made and more like weather. But someone did make this decision, and it has a specific target, a specific dollar line, and a specific group of people who are about to feel it while their coworkers earning slightly less feel nothing at all. Two people can sit at desks next to each other, the same age, saving into the same plan, and this rule will hit one of them and completely skip the other. The thing that decides which one is you is a number on a form you probably have never looked at closely. So before we talk about what you can do, you need to understand exactly what this rule says in plain English with nothing hidden. Because the people who understand it have options. The people who do not will simply find out in the spring, when the tax bill is already written. Let me show you precisely what changed. Strip away the jargon and the rule is short. If you are 50 or older, and you earned above a certain amount last year from the employer whose retirement plan you are in, then any catch-up contribution you make in 2026 can no longer go into a traditional pre-tax account. It has to go into a Roth account, with money that has already been taxed. That is the entire change in one sentence. To make sense of why that matters, you need two words, traditional and Roth. The IRS explains the difference this way. A traditional contribution goes in before tax. You get a deduction the year you make it, your taxable income drops, and you pay the tax decades later when you pull the money out in retirement. A Roth contribution is the mirror image. You get no deduction today. You pay the tax now on every dollar you put in, and in exchange the money grows and comes out completely tax-free later. As long as you follow the rules, including a 5-year holding period that Investopedia notes applies to the account. For most of the history of the 401k, you got to choose. Traditional or Roth, your call, based on whether you thought your tax rate would be higher now or higher in retirement. What Secure 2 Section 603 does, according to the IRS final regulations, is take that choice away from higher earners for one specific slice of their savings, the catch-up. For those workers, the catch-up is now forced into Roth. Pay the tax now, whether that is smart for your situation or not. Here is the piece that surprises people most. This does not touch your regular contributions. The main chunk of money you put into your 401k every year, up to the standard limit, you can still make the traditional pre-tax way if your plan allows it. The forced Roth rule applies only to the catch-up portion, the extra amount people 50 and older are allowed to add on top. So it is not your whole retirement account changing. It is the bonus savings, the part specifically designed to help people nearing retirement move faster, that Washington has decided you must now pay tax on up front. Think about the logic of that for a moment, because it tells you what this is really about. The government did not make this change to help you. If they wanted to help higher earners save, they would have left the choice alone. They forced the Roth treatment because a Roth contribution generates tax revenue today, in the current year, while a traditional contribution costs the Treasury revenue today and only pays it back years down the road. By flipping the catch-up to Roth, Washington pulls tax dollars forward, out of the future and into the present, from a group of people who were using perfectly legal deductions that the government would rather collect on now. There is one more clause in the rule that becomes very important later, so hold on to it. According to the final regulations, if your workplace plan does not actually offer a Roth option, then affected higher earners may not be able to make catch-up contributions at all until the plan adds one. In other words, the rule does not just change how you save. In some cases, if your employer has not updated the plan, it can temporarily block you from making the catch-up entirely. That is a trap sitting quietly inside a lot of plans right now, and most workers have no idea it is there. So that is the rule. Catch-up contributions forced into Roth for higher earners, pay tax now instead of later, and a hidden risk that some plans cannot handle it yet. Simple enough. But everything now depends on one question, the question that decides whether any of this applies to you at all. Who counts as a higher earner in the eyes of this rule? Because the answer is not what most people assume, and the exact dollar line is the difference between paying thousands more in tax this year and paying nothing extra at all. Here is where you find out if this is your problem or someone else's. And I want you to listen closely, because almost everyone gets the threshold wrong on the first guess. The line is not your household income. It is not your total income from every source. According to the IRS, the rule looks at one specific number. It is the wages you earned in the prior year from the single employer that sponsors your retirement plan, and specifically your FICA wages, the earnings that Social Security tax is calculated on. On your tax paperwork, that figure sits in Box 3 of the W-2 form your employer gives you, not Box 1, Box 3. That is the number Washington uses to decide whether you are caught. Now the amount. The base figure written into the law is $145,000, but that figure is adjusted upward over time for the cost of living, and it has already moved. According to the IRS guidance, for the 2026 rule, which looks back at what you earned in 2025, the threshold is $150,000. So the practical test is this. If your FICA wages from your plan sponsoring employer in 2025 were above $150,000, then in 2026 your catch-up contributions must be Roth. If they were at or below that line, nothing changes for you. You keep your choice. Sit with how sharp that edge is. A person who earned $149,000 last year is completely untouched. Their coworker who earned $151,000 is caught for the entire year. $2,000 of income, and one of them loses a valuable tax deduction while the other keeps it. There is no gentle phase-in, no gradual scaling. You are on one side of the line or the other, and the line is drawn at a number many working professionals in their 50s cross without ever thinking of themselves as wealthy. There are a few details inside this that matter a great deal to specific people. First, the age test. According to Investopedia and the IRS, the rule applies to workers who are 50 or older, since that is who is eligible to make catch-up contributions in the first place. Second, it is per employer. The threshold looks at wages from the specific employer sponsoring your plan. So if you change jobs or you have income from multiple sources, the number that counts is the FICA wage from that one employer, not your grand total. The final regulations did add that plan administrators may, in certain cases involving related employers, combine wages, but for most people it is the single employer figure that decides it. Third, and this is the one people miss, the threshold is indexed and will keep climbing. It started at 145,000. It is 150,000 for this round, and it will rise again in future years with inflation. That sounds like relief, but be careful, because wages rise with inflation too. Over time, more and more ordinary professionals, not executives, just experienced workers with long careers and solid but unremarkable salaries, will drift across that line as their pay grows. The threshold and your paycheck are climbing the same staircase, and there is no guarantee your paycheck stays below it. So run the test on yourself right now, in your head. Pull up the mental image of your 2025 income from your main job. Was your Social Security wage figure above $150,000? If you honestly do not know, that is not a small gap in your knowledge. That is the exact number that determines whether you owe more tax this year, and you can find it in about 30 seconds by looking at box 3 of your W-2, which I will come back to at the end because it is one of the two things I want you to check this week. But knowing whether you are caught is only half of it. The real question, the one that decides whether this rule is a minor annoyance or a genuine hit to your finances, is what it actually costs you to pay that tax now instead of later. And the answer depends on something most people never calculate. Let me be fair about this, because the honest picture has two sides, and anyone who tells you this rule is pure disaster or pure gift is selling you something. Start with what you lose, because that is what stings first. When your catch-up was traditional, every dollar you put in came off your taxable income for that year. If you are a higher earner, you are very likely in one of the upper federal tax brackets, which means that deduction was saving you a meaningful share of every dollar contributed. According to standard tax math that SmartAsset and other outlets lay out, a person in a high bracket could be losing a deduction worth a real percentage of their catch-up every single year. Multiply that across the several $1,000s a catch-up allows, and across the years between now and retirement, and the lost deductions add up to a number that is not trivial. For someone right in their peak earning years, this is one of the worst moments in life to give up a deduction, because their tax rate is about as high as it will ever be. That is the loss. Now the other side, because it is real too. A Roth is not a punishment. In exchange for paying tax now, the money grows tax-free and comes out tax-free in retirement. According to Investopedia, once you satisfy the 5-year rule and the age requirement, qualified Roth withdrawals are not taxed at all. And here is the part people forget. Roth accounts have historically not been subject to the required minimum distributions that forced traditional account holders to start pulling money out and paying tax on it later in life. So for some people, especially those who expect to have plenty of taxable income in retirement, being pushed into Roth is not actually a loss. It might even help. So who really gets hurt and who quietly benefits? The answer comes down to one comparison: your tax rate now versus your tax rate in retirement. If you are in a high bracket today and you expect to be in a much lower bracket in retirement, then being forced to pay the tax now, at your high rate, instead of later at your low rate, is a genuine loss. You are prepaying tax at the worst possible price. But if you expect your retirement income and your tax rate to stay high, whether from pensions, investments, or Social Security stacking up, then locking in tax-free growth through a Roth could actually work in your favor. The problem, And the reason this rule rubs so many people the wrong way is that the government took the choice away. Before, you got to make that judgment yourself, based on your own situation. Now Washington makes it for you, and it makes the same choice for everyone above the line regardless of whether it fits their circumstances. The person for whom traditional was clearly the smarter move no longer gets to make that move. That is the real grievance here. Not that Roth is bad, but that a decision that should depend entirely on your personal finances has been standardized into a single rule that helps the Treasury's cash flow and ignores yours. And there is a subtler cost that almost no one mentions. When you pay the tax on your ketchup now, that tax money is gone. It cannot grow for you. In a traditional account, the dollars that would have gone to tax stay invested and compound for decades before you settle up. In the forced Roth, you settle up immediately, so a chunk that could have been working for you in the market instead goes to Washington this April. Over a long enough horizon, that loss compounding is its own quiet penalty, one that never shows up as a line on any bill. Picture two neighbors to make it concrete. Both are 58, both saving hard for a retirement they can finally see coming. One earned $148,000 last year, the other $156,000. Same street, same age, same goal. The first neighbor makes the exact same catch-up she made last year, gets the exact same deduction, and pays the exact same tax. Nothing in her world changed. The second neighbor, $8,000 of income higher, loses the deduction entirely and pays full tax on his catch-up this year. If he is in a high bracket, that is a real four-figure difference in what he owes, on the same savings move, decided by a wage gap that in the real world means almost nothing about who is wealthier or who needs the break more. That is the arbitrariness people feel in their gut, even when they cannot name the rule behind it. So the size of the hit depends entirely on your numbers, which is why the next thing you need is the actual figures, the real dollar amounts in play for 2026, because the size of the catch-up is bigger than most people realize, and for one specific age group, it is dramatically bigger. Let me give you the figures, because vague talk about catch-up contributions hides just how much money this rule is actually steering. A catch-up contribution is not pocket change. For workers 50 and older, it is a substantial amount stacked on top of the already sizable standard 401k limit, letting people in the back half of their careers pour extra money into retirement fast. According to the IRS, the standard contribution limits and the catch-up amounts are adjusted for inflation each year, and for 2026 they moved up again. The catch-up for people 50 and older is several $1,000s a year on its own, and every one of those dollars is now, for higher earners, forced into Roth and taxed up front. But here is the figure that should make one specific group pay very close attention. Thanks to Secure 2, there is a special, larger catch-up for people in a narrow age window, workers who are 60, 61, 62, and 63. According to Kiplinger and the IRS, this enhanced catch-up lets people in that age band contribute significantly more than the standard catch-up, and for 2026 that higher amount reaches up to $11,250. That is the super catch-up, and it exists precisely because those are the final sprint years before retirement, when people try to cram in as much as they can. Now connect the two rules. If you are between 60 and 63 and you earn above the threshold, you have the largest catch-up allowance of anyone, potentially over $11,000, and every dollar of it is now forced into Roth and taxed this year. The people with the biggest catch-up opportunity are, in many cases, the exact people this rule hits hardest, because the more you were allowed to contribute, the more of it now gets taxed up front. The rule quietly bites deepest at the people closest to retirement, the ones with the least time to adjust. Let me put a rough shape on the dollars without pretending I know your exact bracket. Imagine a worker in their early 60s, above the income line, making the full enhanced catch-up of around $11,000. Under the old rules, that entire amount reduced their taxable income, and at a high bracket that deduction was worth thousands of dollars in tax savings that year. Under the new rule, that deduction disappears. The same $11,000 goes in, but now they pay full tax on it at their top rate. Depending on the bracket, That is a swing of thousands of dollars in a single year, moving from your pocket to the treasury on this one slice of your savings alone. And remember, this is not a one-time event. It repeats every year. You keep making the catch-up and keep earning above the line. Year after year, the deduction you used to get is gone, and the tax you used to defer is due now. Stretch that across the 5, 8, 10 years. Someone might work past 50 while earning well, and the cumulative shift is not a rounding error. It is a meaningful chunk of the tax planning that experienced workers had built their retirement strategy around. There is one bit of good news hidden in the numbers, and it is worth saying plainly so this does not tip into alarm. The rule does not reduce how much you can save. Your ability to contribute is unchanged. You can still put in the full catch-up. This is purely about the timing of the tax, not the size of the opportunity. For a saver who is going to choose Roth anyway, or for someone whose retirement tax rate will be high, the practical damage may be small or even non-existent. The sharp pain is concentrated on higher earners in high brackets today who expect lower brackets tomorrow, and who just lost the ability to plan around that. So that is who gets hit and how hard. But the story has a strange twist, because for all the people this rule catches, there is another group that Washington, whether by design or by accident, left standing completely outside the fence. And whether you are in that group changes everything. For every rule that catches someone, there is a line, and just on the other side of that line stands a group the rule does not touch. Understanding who got left out tells you as much about this policy as understanding who got caught, and for some of you, it is the most useful thing in this entire video. Start with the most obvious group, anyone earning at or below the threshold. As we covered, if your FICA wages from your plan sponsoring employer were $150,000 or less in 2025, this rule simply does not apply to you in 2026. You keep the full choice between traditional and Roth for your catch-up, exactly as before. According to the IRS, nothing about the mechanics of your savings changes. You are outside the fence, and a great many hardworking people in their 50s and 60s are in exactly this position and can stop worrying right now. Now a less obvious group, and this one is important. The rule keys off FICA wages, the earnings subject to Social Security tax and reported in Box 3 of the W-2. But not everyone has FICA wages. According to how the rule is written, certain people who earn their income in ways that are not classified as FICA wages from a plan sponsoring employer may fall outside the trigger. Some business owners and partners, for example, take income in forms that are not standard W-2 FICA wages, and depending on the structure, that income may not count toward the threshold the same way a salary does. This is exactly the kind of detail where two people with similar total incomes can land on opposite sides of the rule purely because of how their pay is legally structured. Then there is the self-employed angle, a person running their own operation, contributing through the kind of plan available to independent earners, may not have the same FICA wage trigger that a salaried employee at a large company has. I want to be careful here, because these situations get technical fast, and the details depend heavily on the specific plan and how income is reported, which is exactly the sort of thing a qualified professional should look at for your case. But the broad point stands. The rule was aimed at high-earning W-2 employees at companies with formal 401k plans, and people whose working lives are structured differently do not all fit neatly inside its walls. And here is the twist that is almost darkly funny. Remember the clause about plans that do not offer a Roth option. According to the final regulations, if your employer's plan has no Roth feature, higher earners at that plan may be unable to make catch-up contributions at all until the plan adds one. So in a strange way, being at an unprepared employer does not exempt you in a good way. It can lock you out of the catch-up entirely, which is worse, not better. The people truly left out in a favorable sense are the ones below the income line, and the ones whose income simply does not trigger the FICA wage test, not the ones stuck at a plan that failed to update. Why does all this matter to you specifically? Because it means the rule is not as universal as the headlines suggest, and your exact situation, your income structure, your employer's plan, the box on your W-2, determines everything. This is precisely the kind of policy where a 30-minute conversation with someone who knows your details can be worth a great deal, because the difference between being inside the fence and outside it can come down to a technicality you would never spot on your own. That raises a question worth sitting with. Why would Washington design something this uneven, this full of sharp edges and odd exemptions, and roll it out now, in this particular year? The answer says a lot about where the country's finances are headed, and about a strategy that goes far beyond this single rule. To understand why this landed in 2026, you have to understand that it was supposed to land sooner, and the delay tells the real story. According to the IRS, this Roth catch-up requirement was originally scheduled to take effect back in 2024. But when the deadline approached, something happened that rarely gets talked about. The employers, the payroll companies, and the retirement plan administrators of America essentially raised their hands and said they were not ready. The systems that run payroll and retirement contributions could not be reprogrammed in time to correctly sort higher earners into forced Roth catch-ups. So the IRS granted what it called an administrative transition period, a 2-year delay, pushing the real start to January of 2026. That is why a law from 2022 is only now reaching your paycheck. Then, in September of 2025, the Treasury and the IRS released the final regulations, the detailed rulebook that tells employers exactly how to comply. That is the document that turned a delayed, fuzzy requirement into a hard operational reality for 2026. So the timing is not random. It is the end of a long runway. A provision passed in 2022, delayed from 2024, finalized in 2025, and switched on in 2026. Now the deeper why. Why force Roth on higher earners at all? Follow the money, because that is what this is about. When you contribute to a traditional pre-tax account, the government loses tax revenue in that year and only collects it decades later when you withdraw. When you contribute to a Roth, the government collects the tax now. For a country facing enormous budget pressures and growing deficits, pulling tax revenue forward, out of the distant future and into the present, is extraordinarily attractive. It lets Washington book income today that it would otherwise not see for 20 or 30 years. There is a term worth understanding here, because it explains why the timing works the way it does. In government budgeting, a dollar of tax collected today counts differently than a dollar collected in 30 years. Lawmakers score the cost of legislation over a fixed window, often 10 years, and a provision that pulls revenue into that window can offset the cost of other things Congress wants to do. Forcing higher earners to prepay tax on their catch-up does exactly that. It manufactures revenue inside the scoring window, on paper today, from taxes those workers would otherwise have paid quietly decades later. The retiree loses the timing advantage, and the budget gains a number it can point to now. Analysts have a name for this broader trend. They call it Rothification, the gradual pushing of retirement savings out of pre-tax accounts and into Roth accounts, not because it is better for savers, but because it improves the government's cash flow. This catch-up rule is one piece of that larger pattern. It targets higher earners first, because that is where the biggest deductions, and therefore the biggest immediate revenue gains, are concentrated. You are, in effect, being asked to prepay taxes you would otherwise have paid much later, so that the federal books look better today. And there is a political elegance to doing it this way that you should recognize, because you will see it again. This was not passed as a tax increase. No politician had to stand up and vote to raise taxes on the middle and upper middle class. Instead, it was folded into a retirement savings law with a broadly popular name, Secure, full of genuinely helpful provisions, with this revenue raiser tucked inside. The result is a tax increase in effect, a real one, on a specific group of Americans that never had to be called a tax increase at all. That is not a conspiracy theory. It is simply how modern fiscal policy is written, and once you see the pattern, you will spot it in law after law. So this is not really about retirement policy. It is about revenue, timing, and the quiet art of raising money from people without ever using the word tax. Which brings us to the people caught in the middle of all this, the employers and experts scrambling to make it work, and what they are actually saying about how ready or unready the system really is. If you want to know how big a change this really is, do not just listen to Washington. Listen to the people who have to actually make it work, because their reaction has been telling. Remember, the reason this got delayed 2 years in the first place is that the retirement industry said it could not be done in time. That is a remarkable admission. According to the IRS transition guidance, plan sponsors and payroll providers needed the extra runway to rebuild their systems, because correctly applying this rule is genuinely complicated. A payroll system now has to know each employee's prior year FICA wages, compare them to a threshold that changes annually, check the person's age, determine whether the plan even offers Roth, and then route the catch-up money to the correct type of account. Multiply that across millions of workers and thousands of plans, and you begin to see why the industry needed years, not months. Tax and retirement professionals writing at outlets like Kiplinger, Investopedia, and SmartAsset have spent much of the last year trying to explain this rule to a public that mostly has not heard of it, and a consistent theme runs through their coverage. This is a meaningful change that a lot of affected people simply do not know about yet. The awareness gap is real. Many higher earners will make their usual catch-up election in 2026, assuming nothing has changed, and only discover the difference when they see the tax treatment, or when their employer's system quietly reroutes the money for them. There's also a practical warning that keeps coming up in the professional coverage, and it is the one about plans that were not ready. Advisors have flagged that if your employer's plan does not offer a Roth option, you could find yourself unable to make catch-up contributions at all under the new rule, at least until the plan is updated. That means the burden is not only on you. It is on your employer to have done the work. And not every employer, especially smaller ones, moved quickly. So part of what experts are urging is simple. Confirm that your own plan is actually ready, because the rule can hit you sideways if your employer dropped the ball. Now, I want to be careful and fair here, because there is another side. Some financial professionals point out that for a meaningful number of savers, being nudged into Roth is not a catastrophe and can even be beneficial, particularly for those who expect high income in retirement or who want to avoid required minimum distributions later. According to that view, the rule accelerates something many advisors were already recommending to certain clients. So the expert consensus is not that this is a disaster. It is more nuanced. It is that this is a significant, poorly publicized change that helps some people, hurts others, and demands that you understand your own situation rather than assume it is fine. The common thread across all of it, from the industry that needed years to prepare, to the advisors still explaining it, to the employers racing to update plans, is that this rule is bigger and more disruptive than its quiet arrival suggests. It reshaped payroll systems across the country. It forced a 2-year national delay, and it is landing on millions of people who never got a clear heads-up. That gap between how big this actually is and how little most affected people know is exactly the gap this video exists to close. So let me turn from the problem to the practical. If you are one of the people this touches, what can you actually do about it? Because there are concrete steps, things you can check and consider this week, and knowing them is the difference between being caught off guard and being prepared. Let me give you the practical part, framed carefully. I'm not going to tell you what you should do, because the right move depends entirely on your personal finances, and that is a conversation for you and a qualified professional. But I can tell you what people in your position are looking at, and the specific things you can check yourself this week to understand where you stand. The first thing, and I promised you this at the very start, is to find your number. Pull out your most recent W-2, the one for 2025, and look at box 3. That is your Social Security wages, your FICA wages, the exact figure this rule uses. Compare it to the $150,000 threshold. If it is above the line, this rule applies to you in 2026. If it is at or below, it does not. That one check, which takes about a minute, tells you whether any of this is even your concern. According to the IRS, this is the number that decides it, so start there before you do anything else. The second thing to check is your plan itself. Contact your employer's human resources department or your plan administrator and ask two direct questions. Does the plan offer a Roth option? And is the plan set up to handle the new Roth catch-up requirement for higher earners? This matters because, as we discussed, if the plan does not offer Roth, you could be blocked from making catch-up contributions at all. You want to know that now, in the early part of the year, not in December when it is too late to adjust your saving for the year. Confirming your plan is ready is entirely within your control and costs you nothing but a phone call or an email. Beyond those two checks, here is what some people in this situation are considering, framed as options that experts point to, not as advice. Some are re-examining their overall balance between pre-tax and Roth savings, since a portion of their savings is now forced into Roth whether they like it or not, and they want to plan the rest of their contributions with that in mind. Some who expect to be in a much lower bracket in retirement are talking to their advisors about whether other pre-tax vehicles or timing strategies make sense for the money they can still control. Others, especially those already leaning toward Roth, are simply accepting the change and moving on, because for them it barely alters the plan. It is also worth timing that phone call well. If you find out in January that your plan is ready and where you stand, you have the whole year to shape your contributions deliberately. If you find out in December, most of your options for the year are already gone. The cost of checking early is a few minutes. The cost of checking late can be an entire year of decisions you never got to make on purpose. One path that gets discussed is making sure you are still capturing every dollar of employer match and every bit of the standard pre-tax contribution you are entitled to, since those are unaffected, before worrying about the catch-up piece. Another is coordinating this with the bigger picture of your retirement tax strategy, because a change to one slice of your savings ripples through the whole plan, and looking at it in isolation can lead to the wrong conclusion. The single most valuable thing I can tell you is this: do not assume and do not guess. The people who will handle this rule well are the ones who find out their exact situation, their box 3 number, their plan's readiness, their own bracket now versus later, and make a deliberate decision. The people who will be caught off guard are the ones who never looked. You now know more about this rule than the vast majority of people it affects, and that knowledge is the whole advantage. Use it to have a real conversation with someone who can look at your specific numbers. Which leaves one last thing to cover. Where this is all heading next, what to keep your eye on in the months and years ahead, and the honest limits of what anyone can tell you about your own situation. So where does this go from here, and what should you keep watching? First, watch the threshold. Right now the line sits at $150,000 for the 2026 rule, indexed up from the base of $145,000 written into the law. According to the IRS, that number will keep rising with the cost of living in future years. But as we discussed, wages rise too, which means that over time more and more ordinary experienced workers, not just high flyers, will cross into this rule. Keep an eye on where the threshold lands each year, and whether your own income is drifting toward it, because a rule that feels like someone else's problem today can quietly become yours in a few years. Second, watch for the broader pattern. This catch-up change is one piece of the larger Rothification trend, the steady pushing of retirement money out of pre-tax accounts and into Roth to pull tax revenue forward. Given the country's budget pressures, it would be naive to assume this is the last such move. Watch future legislation for more provisions that quietly shift when you pay tax, especially ones tucked inside bills with friendly names. Now that you know what this pattern looks like, you will recognize the next one faster than most people. Third, watch your own plan over the coming year. Employers are still catching up to this rule, and if yours was not ready on day one, it may add or refine its Roth option as the year goes on. Stay in contact with your plan administrator, especially if you intend to make catch-up contributions, so a plan that was not ready in January does not cost you the chance to contribute later in the year. And here is the honest bottom line. Whether this rule helps you, hurts you, or barely touches you comes down to details that are specific to you. Your income, your bracket now versus in retirement, how your pay is structured, and what your plan offers. There is no single answer that fits everyone above the line, which is exactly why the government taking away the choice is what frustrates people most. The best thing you can do is get informed about your own numbers and then get real guidance built around them. This video is for informational purposes only and does not constitute financial, legal, or tax advice. Laws and policies change. Always consult a qualified professional before making any financial decisions. Let me leave you with the one thing worth carrying out of all this. A quiet change, buried in a law most people never read, delayed for years and switched on without a headline, just reached into the retirement savings of millions of older workers and changed when they pay their taxes. It did it without ever being called a tax increase. You did not get a letter. You got this. And now you know to check box 3, to call your plan, and to never again assume that the absence of an announcement means the absence of a change. In Washington, the things that cost you the most are almost always the ones that arrive the most quietly.